Hello everyone, I am Michael Ruger. I am the managing partner of Greenbush Financial Group. The topic we're going to be discussing today is kiddie tax and other pitfalls associated with gifting assets to your children. Now, most parents will try and gift assets down to their children in a tax strategy, saying, hey, if I shift the income or capital gains down to my kids, I get it out of my high bracket, I'll push it down to my children that have little or no income tax and they'll pay little or no tax on it. Unfortunately, the IRS is well aware of this strategy, which is why in 1986, they created something called kiddie tax, which then pushes that income realized by the child back up into the parent's rate. And we'll talk about that today because that's one of the primary trip ups in that tax strategy. The other two strategies what parents will use to kind of push assets down to their kids, the one is to avoid a spend down process associated with a long-term care event and nursing home. And the third being sometimes parents will gift assets to their kids to avoid probate when they pass away and try to pass assets on to the children. But all three of those strategies, the tax strategy, the long-term care strategy, and the probate strategy, all have pitfalls that usually people don't find out until well after the gift has been made. So some of the topics we're going to cover today are the kiddie tax rules. We're going to cover children with self-directed investment accounts that can trigger kiddie tax, treatment of long-term capital gains, the gifting cost basis rules, how gifting can impact college financial aid, considerations around the control of the assets that you're gifting, the 5-year look back rule, divorce, lawsuits, and distribution from child-owned IRAs. Let's jump right into how kiddie tax works. So if your child has unearned income over a certain amount in a given year, that unearned income could be taxed not at their low rate, but at the parent's higher rate. And like I said, it's unearned income. Earned income is like wages, salary, tips, self-employment income. That does not trigger kiddie tax. What kiddie tax applies to is just the unearned income opponent, which can include taxable interest, dividends, capital gains, taxable scholarships, income produced by gift from the grandparents, income produced by UTMA or UGMA accounts, and also IRA distributions from IRAs that are owned by the child. There are some exceptions to the rule, but in general, if your child is either under the age of 19 or is between the ages of 19 and 23 and is a full-time student, this kiddie tax could apply. There are two exceptions to that rule. The first being if your child has enough earned income to provide more than 50% of their own support, they may be able to claim themselves on their own tax return. The second being if your child files a tax return as married filing joint, that is the second exception. How does the kiddie tax calculation work? So remember, we are just talking about unearned income of the child. So the way the calculation works is for 2022, the first $1,150 of unearned income is not taxed. The next $1,150 is taxed at the child's rate, and then anything over and above $2,300 then triggers the kiddie tax and it's taxed at the parent's rate. Let's look at an example. So let's say parents have bought Apple stock a long time ago and they have a $30,000 unrealized gain built up into that stock. And the thought process is, well, if they sell it, they're going to have to pay a federal 15% long-term cap gains rate. So maybe they shift it down to their child who has little to no income and they could realize maybe most of that gain at a 0% tax rate. The flaw in that is if you gift that stock to your child and then they realize that $30,000 gain, as I just explained, the first $2,300 may be tax-free, but any gain over and above that $2,300 would just be taxed at the parent's taxable rate anyways due to kiddie tax. Another question that comes up while we're discussing kiddie tax with our small business owner clients is if they put their kids on the payroll, can that potentially trigger kiddie tax? And because it's actually earned income, they may be getting a W-2, earned income is not subject to kiddie tax, so that strategy of potentially shifting income from the parent down to the child via payroll through a company, kiddie tax does not apply. Here's a new one that's come up in more recent years. So it's now becoming more and more common for high school and college students to have their own self-directed brokerage accounts. Robinhood, Fidelity, all these platforms have made it much easier for students to gain access to investments, and they may be trading stocks, ETFs, crypto, whatever they're trading, but that is creating potentially gains when they're buying and selling stuff in that account. So the parents might not even know during the year that, hey, your child sold something that created a $10,000 gain. That come around tax time, they're going to get that tax form, and then the parents get the surprise that, oh, kiddie tax is going to be due on that amount. How do you report kiddie tax on your tax return if it applies? So I spoke to a few CPAs on this and asked them how they direct their clients. So again, child has earned income over and above the $2,300. Normally what they'll have the child do is, even though there may be a dependent, they'll file their own tax return, and with their tax return, they will attach an 8615 tax form, which runs it through the kiddie tax calculation and then subjects that income over and above that $2,300 to the parent's rate. Now, we've covered kiddie tax, but there are other major pitfalls that people get into when they gift assets to their children. And one of the big ones is college financial aid planning. So college has gotten more expensive. Parents may be expecting more financial need-based aid. And the way the FAFSA process works is it weights much more heavily against financial aid if there's assets or income of the child versus assets and income of the parent. The way the asset calculation works is if it's an asset of the parent, the balance of that asset usually counts 5.6% against the financial aid that you are awarded, versus if it's actually the asset of the child, that balance now counts 20% against the financial aid that you'll be awarded. So if you look at giving them that $30,000 stock, you might have just cost yourself $4,300 per year in financial aid. Unfortunately, the income side is worse. So we just talked about assets, but when we talk about income in the FAFSA calculation, for the parent's income, it's a range between 22% and 47% of the parent's income will count against financial aid. If it's income of the child, so you gifted them an income producing asset, or they realized the capital gain that was in their name, 50% of the child's income will count against that financial aid. And it's also important to understand that it's a 2-year look back period for income. So if you do this when your child's a sophomore or junior in high school, that could come back to haunt you 2 years later when they enter college and you didn't even realize it. We also talk with clients about having a real good understanding how long-term capital gains work. So as long as you're under certain levels of income, which are fairly high, when you realize a long-term capital gain, you pay usually federally a flat 15% rate. And that matters whether it's a $20,000 long-term cap gain or a $200,000 long-term cap gain. Again, as long as you don't breach up into those other thresholds. And the reason why I mention this is, if you go through all this trouble to kind of say, hey, I'm going to shift this asset out of my name down to my child so they pay it, really if the kiddie tax applies, all you're saving is that first $2,300 times 15%. It's very, very small. So we always kind of say, before going through jumping all the hoops, like if you're going to pay 15% and the child's going to pay 15%, both are probably preferential tax rates over where your ordinary income tax is. Maybe it makes sense just to take the gain. Another big pitfall is understanding the cost basis rules associated with making a gift. Some people think that as a parent, if I gift an asset to my child, I get some type of tax deduction or it somehow wipes out the gain. It doesn't. So if I gift an asset to my child, they inherit my cost basis in that asset. So in an example, I own this Apple stock. It's got that $30,000 unrealized gain. I gift it to my child. I don't receive any tax deduction. They sell it the next day. They're going to have to realize that $30,000 unrealized gain, even though the gift took place. Building on this cost basis issue associated with gifts are the individuals that decide to gift assets to their children to avoid probate when they pass away and then pass the assets to their children. This cost basis issue is big because let's say you own a house and instead of wanting your house to go through probate, you gift the house to your kids while you're still alive. Let's say you bought that house 20 years ago for $200,000 and now it's worth $400,000. Because you gifted them the asset, they now inherit your cost basis. So when you pass and they sell the house, they're going to have to pay tax on that full gain. Versus if you did it a different way, let's say you put it into a trust for it to avoid probate, or that investment account, you made it a transfer on death account so it avoided probate. Now your beneficiaries receive what's called a step up in basis, meaning their cost basis steps up to the value of that property or account on the day you pass away. So when they sell it the next day, there's no tax liability. Another tricky situation are IRAs that are owned by a child. So sometimes children will inherit IRAs from a parent or grandparent, and as a non-spouse beneficiary, they may be required to take RMDs, requirement of distributions, which are distributions each year from that account, which are subject to ordinary income tax rates, or if large distributions are taken out of those accounts, they're also subject to ordinary income tax rates. Because IRA distributions are considered unearned income, that can trigger kiddie tax. It may not be taxed at the child's rate. It may then bump up to the parent's tax rate. The next three pitfalls are control, divorce, and lawsuit. So with control, I mean, if you gift an asset to your child, while your intent may be to use it for college or to use it for something else, they have full control over the account. Even if it's an UTMA or UGMA account, when they turn age of majority for their state, they have full control. So they might do something with an asset that you do not want them to do associated with a gift. So just think about that. The other is, lawsuits. So if your child has substantial assets in their name and they do something and they get sued, those assets are now subject potentially to that lawsuit. And the third one being divorce, depending on what state they live in and how they title that asset after they're gifted. If they end up getting divorced at some point down the road, some or all of that asset might be considered marital property subject to a split. The last topic I'm going to talk about is the long-term care nursing home protection issue. So people will gift assets to their kids to get it out of their name. So if a long-term care event happens, they can qualify for Medicaid and don't have to spend through all their assets. But here again, the cost basis issue comes into play that if it's a house and they move it over to their kids are now going to have to pay tax on that full amount after you pass away, where instead of gifting it to your kids, if you gifted it to a grantor irrevocable trust, you may be able to protect it from a long-term care event, depending on your state, but also your kids could still receive the step up in basis, which could save them tens of thousands in taxes by going that route instead of a direct gift to the children. I hope this was helpful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.